We have since 1994 every day studied Capex situations, Capex theory, Capex practice, what do companies do, and so on and so on. That's all we do. I graduated, as I'll come into later, I graduated in 1994 right into the pulp and paper industry as an independent consultant. So this is 25 years almost. In 2004 we started focusing our business, and since then, as I mentioned earlier, we only do one thing. If the companies ask us to, well, can't you do that too or that? No, we only do one thing. And we do it in our way only. We're not the kind of consultants to go into companies and ask them sort of, well, what do you need today? We come with this and offer this. If they're not interested, then we walk away, see what I mean. In our products, we've had more than 500 mills or plants. Pulp mills, paper packaging mills, packaging converting plants, tissue with or without converting, lumber mills, and so on. Chemical pulp mills, for instance, I think we've had 130 of those in our products. So we've seen a lot of the business. We've had products we have had mills or plants on 6 continents. There are not many left after that. When it comes to continents, we, as I said earlier, we normally work for the European and North American industry, but also for South American companies. And today, what I'm going to talk about today is how companies apply their Capex process and how universities teach us to make those decisions lead to massive capital destruction. It is enormous, okay? It's crazy. And I think you will see what I mean when we're done here today. So, what are we talking about here? Well, you probably have heard comments like, we want to maximize the value from our Capex plan. Okay, you have a Capex plan, you want to get the best value out of it, the most value out of it. You probably heard our business or our mills return on capital employed or similar is higher than our cost of capital, or our EVAs are positive if you use EVAs. Only projects with short paybacks get approved. You're chasing short payback projects. We only do high net present value products, and so on and so on. Okay, comments like this are very common in companies. So what is it really that creates those short paybacks or high net present values and so on? Well, if we have a graph here, we have time down here. I don't know if you can see this red pointer here. Time down here on the x-axis and cash flow up here, and we have a mill. Well, let's say that this mill historically has had a certain level of cash flow. Of course, it goes up and down very much, but if we normalize it like that. And we're here today, and we can say that in the future, it's going to have the same level of cash flow. Again, up and down, like everything else in life, it's up and down a lot. We normalize this. At some point, the mill manager, who in here has been or is a mill manager? Okay, good. Or plant manager. Okay, the mill or plant manager is likely to come to the head office and say, sure, I'll make money like that green line, but to do that I need to invest. I have quality issues. My customers are complaining now, more and more. They come back often, more and more often. So I need to spend money. That's that arrow down. That's the Capex. Okay, cash flow here and money out 1 year, and then they'll make money like that. Then the mill manager will say, if I don't get to spend that Capex, then the cash flow is going to look like that. Okay, and I am now assuming that the data that you use for that green line and that Capex and that dashed cash flow line, the line that's going to happen if you don't invest, everything, the data is perfect. Okay. Throughout this hour that we're going to be in here, or 1.5, whatever, all data is perfect. We're just pretending that. That's not real life, but let's pretend. All data is just perfect, okay? Because personally, I do not think that the pulp and paper industry has a major data issue. Okay, you know somewhat what's going to happen if you do this, and you know something about what's going to happen if you do that, and so on. That's not like that in all industries. Anyways, so you do this investment. So you're on that green line, the green full line. What you do here in this situation is when you calculate on this investment, you take that green line, you take the minus that dashed line, and that creates a delta, an area, and you discount that. Okay, that's the normal thing to do, and you compare it to the capex, and then you calculate a net present value. Okay, or you calculate a payback, discounted or not discounted, or internal rate of return or something like that. Again, I'm assuming now that the data is perfect, so the internal rate of return of 21% or whatever is that exact number, and the net present value of 10 is that exact number, and so on. So you calculate a net present value, internal rate of return, etc. Okay, so you make that decision, and you go ahead, and 3 months later, the mill manager will come to the head office again and say, I need to spend money on this now because I have these cost issues or safety issues or something like that. And this just continues into the future. Okay, now people are smiling in here. Have you ever seen this situation before? Okay. Anyway, so you have this set of investments, and if you stand by the today line and look forward, you can say that all those capexes, that creates your capex plan. Okay, so we have 10 capexes, and you have the capex plan here, those 10 projects here, capex projects, and the first one has the capex net present value from the math that I just showed to you down here of 20. The next one of 15, 40, and so on. And if you sum these up, you get to 200. Again, I'm saying again, the data is perfect. So this is exactly what's going to happen if you carry out these investments. Okay? But what is so interesting about this number 200? Well, for one, the 200 is not in any way connected to the value of the mill. Okay? How is the value of a mill calculated versus a value of a capex? Well, if we return to this one now, and I'll remove the axis, this is how you view a capex decision. You only have the amount for the outlay here, and you calculate that one, you make a forecast of that, and the dashed line, you make a forecast of that, where that's going to go, and you make your investment calculation based on that. Okay, but when you, for instance, face an acquisition of a mill, okay, or if you want to, for other reasons, calculate the value of a mill, you look at the green line only. Okay, you stand here and look at the cash flow that's going to come from that mill going forward, and you calculate the net present value. Okay, that is not the same thing as the calculation here. Okay, there is no mathematical connection between the value of a capex plan and the value of the mill. There is no connection. I'll show you an example. Going back to this picture here, we call this a B mill, and we have our 10 capexes, and we say that that value from that capex plan is 200. Okay, so that's the 200. Okay. Let's say now that we have a mill whose cash flow is around 0 in the future, or even negative. Okay? We see that in 4 out of 5 projects, that the company has at least one mill like that, out of maybe 10 or 20 or 5 or whatever. We call that the C mill. It's going to have those 10 projects, and if those are the same projects, with the same arrows and dashed lines and so on, what is the value going to be for that mill's capex plan? 200. Has to be 200. Okay, because the values you calculate are created by the capex, that line, and the dashed line, and that is held constant. Okay, you don't change anything there. So same numbers for every project, and the result is 200. Okay. And of course, if you have a mill up there with the same capexes, that's the A mill. 1 to 10, that's also going to be 200. Can't be anything else. Okay. But where does this become interesting? Well, in reality, those 3 mills will not have the same capex plan value of 200, because that's not reality. Reality is that if we go back to the C mill down here, they're going to have more issues. Why is a mill or a plant a C plant or a C mill? Well, there could be many reasons. Could be how expensive the fiber is, or if it has a port or not, or you know, so many things. But normally, it's about the status of the mill. Okay, if the equipment is old, if it has a scale, I mean, if it's a small mill or large mill, and so on and so on. And older mills with aging equipment, they are the ones that are going to be down here. They're going to have more issues. They're not just going to have 1 to 10. They're going to have 1, 1B, 2B, 3B, and so on. So they might have twice the amount of products because they have more issues. Okay, like an old car. Not only that, but it's also so that when they do the math on a capex they want to do, okay, they replace a piece of the mill, a small part of the mill, a piece of equipment. That certain piece of equipment that they're sort of talking about in this case has maybe a state-of-the-art level at that, and what they want to replace is down there because it's an old mill. And so they close a large gap for that piece of equipment. Only that piece of equipment, they close that gap. Okay? So they create a large delta in their calculation, and that gives them a faster payback and a higher net present value, if you see what I'm trying to describe. While if you have a really good mill, it's state-of-the-art here, and they were to replace the same piece of equipment, they might be here because they're newer, they're in better shape, so they close a smaller gap, and they then, for the same capex situation, they have a longer payback, lower net present value, and so on. Okay. So, and I illustrate that by that blue line. Their dashed line is not like that, not like the B mill. Okay, it doesn't fall like that; it falls quicker. So they create a larger delta in their calculation. Okay, so that's the C mill. So they will then, for instance, end up with a capex plan value, not of 200 that the B mill had, but maybe of 400. The A mill, they don't have as many issues. They don't have the safety issue. They don't have the environmental issue. They don't have the customer complaints. They don't have the cost opportunities, you know, to fix the energy cost or whatever we're talking about, because they're already in relatively good shape. So they don't have product number 2 up there, or number 4 or 6, etc., etc. They have fewer products, and when they, as I described earlier, when they try to fix something, when they look at an opportunity on the energy side or something else, they close the smaller gaps so their dashed line doesn't fall as quickly. So the value of their capex plan might be something like 100. Okay. What I'm describing now is a situation where you have, if you have a set of mills, that the further down you come to zero cash flow for the mill, what happens to payback? Quicker and quicker payback. Higher and higher net present values. Capex products, if looked upon in isolation, look better and better the worse a mill is. Let's go through this just one more time when it comes to the capex. We have our 3 mills here, B, C, and A. Not in alphabetical order, but in the order where I presented it. And we're saying that we're fixing this amount here, that's the value for the B mill. The C mill, as I mentioned, that mill will have more products. They will come to the head office with a longer list in their capex plan. Not only more products, but also if you look at that 20 up there, it's not going to be 20, it's going to be 25. And they're going to add 1B with 10, and 15 is going to be 20, and so on and so on. Okay? So ending up in 400. Mill A will not have 10 products, just going to have 5 products, And the first one is not going to have the same value as that one. And it's of course not going to be 25. It's going to be lower. Okay? Ending up with a Capex plan worth less. Those three compete for capital in the company. So where is a company likely to invest if you have capital restraints? Okay. Most companies have capital restraints. Apple doesn't, okay. But then there are other companies who do. And, which is also a disturbing thing, it just sort of disturbs my world, is when companies have hurdle rates or discount rates or required rate of returns that are higher than the actual capital cost. That leads to the same behavior, what I'm going to describe now in the following slides. Okay, going back now to this picture here. Companies typically spend sort of like 75% of their resources in so-called B mills. Okay, those are the mills that are not A mills, good performers, and not C mills. Because C mills, companies tend to understand, I say tend to because it's not always like that, definitely not. They tend to understand that they maybe should not invest in mills with zero or negative cash flow, okay? And the A mills, they're so good, they don't really need the money. So they spend, and I'll come back to this more in a while. So they spend like 75% of their resources in B mills. That blue box is not trying to circle any capex or anything, but rather the sort of the area in this graph where I have B mills, okay? So if you have a company whose capex budget is $1 billion or something, 100, sorry, 1,000 there. And the value of the capex budget, okay, the net present value is 1,200. Okay, so they spend 1,000, they get the 1,000 back plus another 1,200. Okay, so that's how it's calculated. And let's say then that the average payback in a normal year is 3 years. What do you think happens if this company, I don't know if you've ever been in that situation, but if this company suddenly runs into a situation where they make less money? Okay, the general economy goes down, for instance, 2008. What happens to a capital budget? Right? The box shrinks. So they experience that the capex budget is not 1,000 anymore, it's 700. But they're smart. They find the most valuable products. So it's the value is still 1,000. You see the relationship here against the 700 is better than 1,200 against 1,000. Okay. So they then maybe have an average payback of 2 years. But where do you find those products? Where do you find the quicker payback products? Down there. Okay. Oh, payback, by the way, is a really interesting term. When do you get payback in the mill that is down here? Remember now that every product that we're looking in here is exactly and correctly calculated. Okay. So everything that they say they're going to achieve when they make a decision here, they achieve exactly that. So the calculated payback is 2 years or 1 year, whatever it is. But when do they actually get payback? When do you get payback in a mill that has negative cash flow? Well, sort of never. Okay? Never. Okay, so you make capex decision after capex decision, and you come to the exact results that you were aiming at getting to, but you don't ever see money. Also, that's so interesting. The term payback is a very deceiving term. Let's now change subject. I'm going to talk about the same thing actually, but I'm going to twist it and talk about it in a different way. Okay? We're going to get to something that we, and you saw that on a small book here, called the tail wags the dog. It's a very common term for when something is backward. Okay? I don't know if you've seen the movie. It's really funny. And we're going to now talk about how capex decisions actually run company strategy. Okay, So again, we have a curve, a graph here where we have still time on the x-axis, but decades. So we're talking about a long time period, decades over that axis, 60, 70 years or something. And up here we have competitiveness, for instance, measured as manufacturing cost per ton. Okay. Anybody work in or ever worked in a pulp mill? Yeah. Or integrated with a pulp mill. Okay. So for a pulp mill, it could, for instance, then be manufacturing cost per ton. What has happened in real terms over the last 30, 40 years or so with manufacturing cost for pulp mills in real terms? Where has that gone for sort of state of the art in every year? The manufacturing cost per ton in real terms, has that gone for a green field that you build, like every year? I don't know how to describe this, but a state of the art mill, do they experience over time, if you build one every year, for each mill, what happens to manufacturing cost? Is that going to go up or down? Down a lot. Okay. Scale 30, 40 years ago on a pulp mill compared to today. Energy situation in a pulp mill 30, 40 years ago compared to today, the difference is enormous. And I'm illustrating that with that red line. That red line can be debated, and please challenge me, if you want to, but what I'm trying to say with this line here is that a pulp mill today, the average pulp mill today, can easily compete with the average pulp mill 30 years ago. Okay, if you were to put them next to each other, could easily outcompete the old one. This red line is the industry average. Okay, saying that in every point in time, you have half of the capacity above the red line and half below. Okay, so that's the red line. That is how that works. Let's say that we are here now, and we're going to build a new pulp line, new fiber line here. We do that hoping and thinking that it's going to be far above industry average at that point. The blue dot is above the red line. State of the art, fantastic pulp mill. When we kick off that project, and start up the pulp mill, it will live for many, many years. That's how it goes with pulp mills, hopefully. And we will improve that mill. Okay, the blue curve goes up, the blue line goes up, but you can never, ever follow state of the art. You can never follow the industry average. You can never go up like that with a specific pulp mill. It's impossible. You cannot do it with a paper machine. You cannot do it with a sawmill, etc., etc. You can improve it, but over time you lose against industry average, and when you get over here 60, 70 years later, you're going to say, okay, it doesn't work anymore. We have lost too much against the industry average, and now we're shutting this down. Okay, so this is a typical life cycle for a pulp mill. I'm going to now use this picture. Let's pretend now that all of us, we own a company. A company with 10 pulp mills. And if we are the average company, we have our average asset exactly on the industry average. We are then likely, if we have 10 mills, to have 3 mills that are above average and 7 that are below average. It means that if half of our capacity is here, it has to be like that, otherwise we would not be on the average. Those 3 are a lot larger, right? And those are smaller. I'm simplifying now, but that is actually how it is, I would say also. I'm now going to do something that we do not do in projects, but just for this picture and for the discussion that I've had, we're going to categorize these. That's the C mill. You remember the C that we talked about before? That is the mill that is furthest away from state-of-the-art technology. Okay. It's the mill that we probably all are thinking, next time we need to take out capacity, that's the mill that goes. Okay. We're not spending much money on that mill. Over here, we have the A category. Really good mills. Again, 50% of our capacity. Good EBITDA margins. Good technology. Well invested, and so on and so on. Newer, larger. And we have 6 mills in between. Those are our B mills. The majority of our mills, almost half of our capacity, including C, it is half of the capacity. Now I'm going to ask you a few questions. I mean, most of you are in the industry, as I understood it. If we take our 3 categories, and I made a table here, and we're going to talk about CapExes, we're going to talk about cash flow, and something that I'll get back to in a while that I call MA. Okay, in a typical year, in a normal pulp and paper company, how much of that company's CapEx budget that the company has for those 10 mills do you think will go into the C mill? How much? Is it going to be 10%, 20, 50? Again, it's the mill that they think they're going to shut down next time they need to take out capacity. So it's not the future of the company. 10%? Yeah. 5%? Normally, companies spend something like 5% in that mill. Because remember, normally that is also the smallest mill. But it's a mill that's going to come to the head office with many ideas of how to improve the mill. The list is long, if you remember. Lots of needs. How much do you think is going to go into the A category? Well invested. Their technology is closer to state of the art. They do not have any safety issues, no environmental issues, etc. 20. On the average, companies spend 20 to 25% into mills like this. I'm not going to ask you for the B, because you probably and hopefully you could do that math. This is, I mean, there are not many companies who deviate from this. And this is so interesting. For me, I look at companies over and over and over again, and basically they all invest like this. There are, I would say, 2 exceptions in the pulp and paper industry. They invest slightly different. Okay, a bit different than this.
I got a question.
Yeah, go ahead.
You got these percentages, but if you look at North America versus Europe,
yeah,
would it be the same percentages?
I would say over the last 20 years, yes.
Okay.
Yeah, the behavior is not different. When I started 20 years ago, people used to tell me, oh, in the US they do like this, they do like, oh, the culture is so different, da, da, da. They run their mills into the ground and they invest, and then they don't invest until they shut it down, and so on and so on. Then I started to do projects here, and I found out that there is no difference in culture at all. Okay, they have the same behavior, they have the same view on what they should do or not, and so on. But assumptions are different. But they're all getting closer to each other, and I'll explain what I mean by assumptions. And that is that if you go back 15 years, labor costs were lower in North America, energy costs were lower, but now they're sort of coming together. So while in Europe you could easier find ways to motivate CapExes by saying that you take out labor costs or energy costs and so on and make decisions on that, you could not really find the motives for that in North America or in the US. So the results from what companies did was different, but the culture is the same. Okay. So the next row here, cash flow after CapExes. That is, the question is, if we stand here today and look 10 years ahead, how much of the company's cash flow is going to come from each and one of these 3 categories? What do you think about C? It's going to be 50%? No, I don't think so. If you're really lucky, 0. Then you are really lucky.
Really lucky.
Yeah. Okay, so as I said, while these CapEx numbers are relatively sort of similar from company to company, these cash flow numbers between A and B is so different, because that actually depends on what type of assets a company has. Okay, we come into companies sometimes when we do project, or normally companies maybe have one A mill, but the majority of the assets over here. Sometimes we do projects where they only have B or C mills. Once we did a project in a company, I don't remember how many mills we had in that project, I think it was like 6 or 7. And their A mill, of some fantastic mill, had 140% of the future cash flow. Yes? Okay, and you could do the math on the rest. So this varies very much. But what we have seen is that the average is that the A category, that has higher margins, right? EBITDA margins, before depreciation, not after necessarily, but before. It's 50% of the capacity, so the future cash flow has, and they have lower capex need. I mean, that you can see that here, right? Okay, so the cash flow has to be more than 50%, and we think, from what we've seen, that the average is about 80%. That means that B has 20. After having spent 75% of the company's capital budget, they deliver 20% on an average. Okay, when I say on an average, you can imagine that, of course, some are then higher and some are even lower. Because 20% is not a very impressive number for 6 mills out of 10. MA stands for something we discussed 20 minutes ago or so, management attention. If you pick your company's 50 or 100 or 500, depending on the size of your company, most important people, okay? You know, when it comes to experts or whatever, you know, management, whatever. Where do they spend their time? Their quality time. I'm not talking about budget meetings, okay? I'm talking about quality time. How much of their time do you think they spend in C? C is about, should we or should we not shut this mill? Now they have this Capex request with a 1-year payback. Why not do that? No, maybe we shouldn't, etc. And then you make the decision to close that mill. We were in a project once where we had an obvious C. They had been talking about shutting that mill for years, but they still had not done it. Once they told us that they had even one of their executive vice presidents on their corporate jet on the way to that mill, and when he to deliver the message, now we're shutting you, okay? And when he arrived and turned his cell phone on, he had a message saying, fly back again, we got the order, so we're not shutting it this time either. You know, and this is how it goes, back and forth all the time. And then you decide, let's shut this. And then you have media, you have labor unions, you need to take care of the people. And you know, it's just so much. So what do you say? What is the percentage here?
25.
Yeah. Some companies say 100%. And I think that is how they experience it. So some companies say 100% because they are in this situation now. When we ask them, they say 100%. But on the average, companies say 30%. In a mill that is worth hopefully 0 at best. Okay. What do you say about A? No issues? So where was I? Okay, over here, A. We had a project in the US once where the project leader from the client side, he had been the mill manager of their prime A over there for 5 years. He claims, and I checked with him when I met him again last year. We did the project with him like 9 years ago or something. I asked him again because I had to check the story if it was just something I had made up. Of course, I never do that, but anyways, if that was the truth, because he said to me then that he was the mill manager for that mill for 5 years. He wasn't contacted by the headquarters even once. The phone never rang. They were somewhere else. Okay. So what do you say about the A category? How much of the management attention do they get? 5%. Half of the capacity gets 5% of the resources. And B gets 65%. So I am certain that this table here is perfect for a certain company, a certain year. I'm certain that is the case. But if a company, year in, year out, spends the resources like that, you're going to run your company into the ground. It's just a matter of time. It won't go quick, okay? Might take you 15, 20 years, but you'll end up in a ditch. Because if you have your company's future somewhere and you spend your resources elsewhere, okay, it's not going to work long term. No way. But why do companies end up here? Because I had my doubts when I started working almost 25 years ago. I doubted whether or not top management really wanted to do what was good for the company and their shareholders. I wasn't certain about that because I saw so many strange things. But I realized later on that they actually wanted to do the right thing, but they couldn't because they didn't know what the right thing was. Okay? We have identified 3 reasons for why companies end up in that table, because they are actually being sucked into it. They gravitate in towards that table. So you remember this, I bring that with me, and let's talk about that mill. It's a B mill. It's not the next C, but it's a B mill, okay? The next C is the one over there, okay? So that's a relatively ordinary B mill. That mill is going to come to the head office and say, I have this issue. And the head office is going to say, yeah, we know. We've been talking about this now for some years. The mill manager is going to say, now I know how to fix it. And they all agree on that, okay? The issue is so obvious, because that's the case with B mills. The issues are so clear, okay? And what I'm trying to say here is that this is number 1 out of 3 of the major issues, the major reasons for why companies end up in this table, okay? And that is, the first one is that the Capex process is and has to be a bottom-up process, okay? But together with the next one, which is when companies evaluate those issues, they use delta calculations to prove if it's good or bad, or to compare alternatives against each other and so on. And they also when they present these net present values, when they present the projects to the head office, they present the products in isolation. Okay, this is that product, and that's that product, and so on and so on. Okay, so these 2 together create that table. Because the mill manager over here will come to the head office and say, I have this obvious issue. Head office is going to say, we know. The mill manager will say, 2 years payback. Okay, now it's getting really difficult to say no to that product. And I'm not saying that they should. The thing is, what I'm saying is, they have no idea. A payback of whatever doesn't indicate in any way, even if it's correctly calculated, if that product should be carried out or not. It doesn't even indicate. Okay? And that's what I'm saying. I don't know if they're going to do it, and they don't. And if it's then further reinforced by the third reason, where return on capital employed or EVAs or any other P&L balance sheet based measure is used to prove the performance of the mill, then you're in real trouble, because in a mill over there, the return on capital employed is just going to look fine. Okay, you have green flags all over the place. It's really difficult to say no to products like that. You could postpone it, okay, but you're going to say yes eventually, because the process tells you to say yes to that Capex. Let's spend a few minutes on this one, then we're going to drop it because it's actually not in focus here. But so number 3, here we go. Okay, you remember this picture? The blue line is the life cycle of a mill. I'm going to keep that and erase the rest and add an x-axis, which is the EBITDA margin over the life cycle. On that side, I have a second x-axis, which is red, and that's how the return on capital employed will look over a life cycle for a mill, or EVA, or whatever other measure. So you're going to see a black curve, which is the margin, and a red curve, which is the return on capital employed. How does the EBITDA margin look over a life cycle for a typical mill? Well, starts out low, it peaks after like 5 years or something, and then it's slowly down. Okay? It has to go down, otherwise you would never come to the conclusion that after 6 years you're going to shut the mill. So an EBITDA peaks, and then it's slowly going downwards. You can work in a mill for 20, 30 years without even noticing it because it goes like that in reality, so you don't see it, but it is going downwards. Now, we have all the information to do the very simple math on EVA or return on capital employed. Okay? We have all the input. The return on capital employed is going to go something like that. It will struggle in the early years, not only because of the startup, but also because of it carries lots of capital. Okay, it's going to do that for 15, 20 years, depending on the depreciation rules. And not only that, it has a large depreciation factor in the P&L. Okay, so the return on capital employed is burdened in the early years. And then you suddenly out of that, your capital is gone and your depreciation factor is gone. You only have the smaller reinvestments, which compared to the initial investment is almost nothing. Then the return on capital employed booms like that. It stays up here for a long time, and only when it starts to become a C, that's when it goes down. So that B, okay, so that's the E category. That's where you find the best mills. They are the ones with the worst return on capital employed, together with the Cs. Okay, it's not unusual that companies think that an A is a C and a C is an A because of this. We did a project, it was like 3 years ago, I think, in Europe, where the top management were thinking about shutting a mill because their return on capital employed was so bad. And it turned out that it was an A mill. Okay? They were just looking at the wrong thing. Anyways, then we have this long B period. That's when the return on capital employed is booming. And then it becomes a C. Oh, by the way, if any of you ever again, or for the first time want to become a mill manager, when should you become a mill manager? And base your bonus on return on capital employed. Well, you find a mill that is like 10, 15 years old or so, and then you stay there for a few years, and then you get rich and you stop working over there. Okay, it's very simple, just simple math.
Thank you very much.
Okay, so I don't know if if you see what I'm trying to say here, but obvious issues, quick paybacks, and by the way, a good contribution to the company's return on capital employed, profitability, the CEO's bonus, all of that, you know. How do you even, and should you, say no to that Capex? Because the flags are large and they are not red, they're green, you know. Everything looks fantastic. You should never involve any type of measure from P&Ls, balance sheets, in any type of decision making ever. Okay, so that goes out. The thing is though, even if we strike number 3 and bring that out of the game, number 1 and number 2 is still going to be in there. And companies must use these, but still they create that table. The thing is that the Capex management process is so strong, it's so established, the board tells you to have it, the universities teach people, this is how you should do it, and so on and so on. So what we have seen, and now you see the dog back here, the tail wags the dog, I'm getting to that. If this is the Capex management process, what we have found, and I think anybody can understand that, is that the Capex management process is so strong that it actually sets the strategy for the assets. The consequences over time from the decisions that you make based on paybacks, based on the obvious needs and the mill management's obvious ability to motivate, you know, the situation, that results even if it wasn't the intention, results in the strategy for the assets. Okay? And this is a bit backwards. That a bunch of tactical decisions end up in a strategy that you never formulated, really. That's today. That's 40 years ago. I started working there. 1994 in Sweden was a terrible year to graduate. Everybody who left university with my degree, I took a degree in economics, went out in unemployment. I think that the general unemployment with people with my degree in Sweden that year was like 20%. Total disaster. Okay, so I had written my thesis on Capex decisions, how to calculate on Capexes, how that relates or actually doesn't relate to return on capital employed, and so on, which my professors tried to tell me that that they were connected, and I simply couldn't believe it, and I wrote my thesis on that and so on. And I finalized my thesis, and I applied for 50 jobs. Nobody contacted me. I didn't get a single interview. Okay. Anyway, so I had a few more classes to take before I was going to take my degree in June 1994. And this is a true story. The evening before I was going to go out in unemployment, I get a phone call from a Swedish pulp and paper company. And this was a Sunday evening. And they tell me, we read your thesis, they said. Okay, this is before, or so that's sort of when internet started becoming, they didn't download it, that's what I'm trying to say. So they found it some other way. Anyways, they said, we read your thesis and we have a project for you if we're interested. The thing is, we have this mill. It's a great mill. Every year, they show us a Capex plan where the average internal rate of return is about 40%. We have been following up Capexes there for a while, and they basically deliver. If they say they're going to take out X number of people, they do that. If they say they're going to take down energy consumption per ton, they do that, and so on. So check on the 40%. Over the last 15 years, that mill has averaged a return on operating capital of 27%. But, and this is why they called me, and this is why they sort of found some interesting stuff in what I had been writing about. But, they said, and this was in 1994, remember that, we have now looked at a new measure. It's called cash flow. The average cash flow in this mill over the last 15 years has been 0. Okay? They wanted me to explain to them how all of this could even happen and what it meant and all of that. And they asked me, can you do that? I had no idea. So I said, sure, I'll do it. Because I didn't have anything else to do. So, and I went in there, and I'm not going to talk much about that, but I actually delivered sort of what they wanted to. I figured out a way of doing that anyway. So, but the point of that story is that during that project, I started out that project, again, as I said, I had no idea what to do, so I did some meaningless stuff in the beginning. I interviewed some people, and I interviewed the controller in the mill. I asked him, what is your mill's philosophy? What is your philosophy when you sort of come up with your Capex plans? Well, he said, we invest according to the going concern principle. Since I was in economics and not accounting, I had to ask him, what does that mean? Okay, because I had never heard the term before. He said, well, you've seen this picture now. We invest, when we try to figure out the plan, we look for mill sustainability, to sustain the mill, okay? To make sure that the mill continues. observe, they're not looking for maximum cash flow, okay? They're looking for survivability, okay? They want to survive. This was in a relatively remote area in Europe. So I understand that. And his answer then in 1994 made sense to me, okay? Okay. It took me 4 years before I realized that going concern, sustainability thinking and so on, creates the whole big problem of capital allocation that we have in capital intensive companies. Each line here, each arrow represents a pulp mill in Sweden. In Sweden, 40 years ago, we had about 110 pulp mills. Now we're down to 30. Those 30 make more than twice the ton of pulp, the tonnage, than the 110 did. So it's not that the market has declined, we all know that. Why does a country go from 110 to 30 pulp mills? You could say, oh, there must be 80 reasons for 80 mills to close, but that's not the case. In a country like Sweden, where we, believe it or not, have market economy, there are only 2 reasons. One is, what happens to pulp per ton in real terms over time? It declines. What happens to costs for each mill in relation to that price decline? Up. Okay? 80 mills could not survive in that environment, while 30 could and grow and sustain. Declining margins, that's what we see. When I started out with this picture, I was in a way giving you a hope, okay? Because that green line was horizontal. That's not the case for a mill. That green line, whatever you try to do in a mill, is actually going down. Declining margins. That dashed line looks like that. Even if you invest, okay? You're not going to see it because the margin is going to do that. We also talked about this, that after it peaks, the margin goes down. That's why mills close. If that wasn't the case, then we would still have 110 pulp mills in Sweden, and we don't. Okay? So we have declining margins. Those mills didn't make it. In Sweden, we love this. It's fantastic. Not even the labor unions complain anymore, because this means growth for the country. Making more out of fewer resources. That's the development a society wants, even if it doesn't necessarily understand it. There are only a few countries on earth that fights this. North Korea, Venezuela, and you can argue that there are a few other countries too, but most countries, they love this, even if they don't really understand it, because it's all about, if you don't accept this, because this is nature, okay? If you do not accept this, you will have less resources for healthcare, schools, etc., etc. You simply have to go with the flow and embrace this, okay? It's the only way. It's fantastic for companies, because they can plan their consolidation, okay? If we don't spend money here, we can spend money there. Oh, whoops, that's not how they do it, do they? Okay, they don't do that. That's the thing. The capital-intensive industry tends to invest heavily in mills 3 to 8 years before closure. There. See that circle? Why? All flags are green. The issues are obvious. Paybacks are quick. Oh, we get the money back. We can spend the money here, and then we can get the money back again. We can spend it elsewhere. Fantastic. Who can argue against that? And the return on capital employed is fantastic, you know, or at least relatively good. Okay? And they keep saying that they're going to fix those issues and we're going to make more money and so on and so on. That's when the big money goes into pulp mills, evaporation plants, bleach plants, wood yards, digesters, recovery boilers. That's where they go in. But you cannot change that. That's inevitable. You may think that replacing a recovery boiler is going to change that. It might delay it for two reasons. The mill is going to be slightly better for a few years, and also the political aspect, and you were into that. If you just have invested in a recovery boiler, you don't want to shut the mill, do you? Okay, so you're going to have a bump here. What do bumps lead to? They simply just lead to lowered pulp prices, and the mill is going to shut for that reason, if nothing else. Okay, so that's when companies invest. So that happens in the industry. In B mills, because of this table, money is spent out here, close to those green lines, because of the going concern thinking. Companies think that not only A, but all Bs will live forever. So that's the thinking. And that is how all the processes around decision making is set up. Okay, there is no other philosophy. Okay, so what should companies do? Well, this is going to continue in the future. Pulp is going to continue to get more and more. The real price fall of pulp is going to continue, no question, and costs are going to go up. So the question is, how do we plan our inevitable closures long term? A company should and must know somewhere around 8 to 10 years before a mill is shut down that this mill is on the short list. They must know that. The thing is that they can know that. Okay, it's not. We're not talking about a crystal ball. It's much simpler than that. Okay. How do we best develop our remaining sustainable footprint? Because it's not only about knowing that, it's also about allocating then capital to where you are sustainable. I have to go back here actually and just say something that I should have said. If you look at this picture up here to the left in the corner up there, I do not know, even if I had a company in front of me with their mills laid out like purse like that, correctly laid out, I do not know if C really is a C mill. If that is the one to shut next or that one. Because the C mill could be the mill with the harbor, with the best people, in the best fire basket. It's just the equipment that is lousy. So if you spent $1.5 billion into that mill, it's going to be the perfect A. Okay? So you can't draw any conclusions by just categorizing mills like that. That doesn't help you. Okay? So what are we going to do? How do we over time adjust our asset base for the growth in product X, the decline in product Y? Okay, a favorite theme in the pulp and paper industry over the last 10 years. In a whole business analysis, companies must maximize their long-term cash flow instead of maximizing the value from individual decisions. By optimizing their future opportunities such as speed-ups, new machines or fiber lines, added capabilities, new products, closures, M&A activities, etc. And it's going to result in, for instance, those two mills being shut down, capacity being added in the best mills. That closure is done earlier so that you can also consolidate that into the same time. At the same time, you move products from there to there, and you plan for a closure of that mill well ahead. Make sure you optimize Capexes there for those two, for that mill, really early. Speed up 2 mills over here, or debottleneck 2 mills, and move products over there, etc., etc., etc. Instead of investing here, where the capital is going to end up if you allocate capital the way companies are set up to allocate it. The best combination of future long-term opportunities that also makes sense and follows possible restrictions becomes the company's asset strategy. Okay, and if that is done correctly, in a good way, then you know how to run the company for many years ahead. Okay? You have a guiding strategy. So when we looked at this before, where we had the Capex management process down here governing the strategy, creating a strategy as a consequence, has to be the other way around. Okay, you must create a strategy that governs your Capex management process instead. And that is what companies have to do. Then, if you do that correctly, it doesn't matter what the payback of a Capex project is, because it is not relevant. That cannot. If you know what your strategy is, then you know how to allocate your capital. Then you can use the bottom-up process and the delta calculations for sort of finding out the best solution. Okay, but those can never help you in allocating your capital. You must allocate your capital using other means. We think that it doesn't matter how companies do it, but they cannot continue and have a decision-making process the way they have had it for the last 40 years. That's impossible, because they are driving the company in a way that's going to ruin the company. Okay, at least make people poorer. And that simply has to stop, and that is what we have said and believed for 15, 20 years. Okay, but companies have not really listened. But we think now that we have a reference list that is good enough, and those are at least listening, you know, because they do believe in what we're saying. All of them. If I walk into a meeting and have on a whiteboard have a presentation like this to a CEO, he cannot really sleep after that, because he knows that he has this big Capex decision to make, and suddenly doesn't know if this is the right mill or not. It all looks so great, but suddenly they don't know that anymore. So things are changing. Okay. So, thank you very much. Any questions, apart from the ones that I've heard? Thank you very much.
Thank you.